Well, it's 7 o'clock, everyone. Welcome for joining us. I appreciate your participation. It looks like we've got 23, 24 participants currently. Just a reminder that the deadline for membership renewals is January 31st. After that, February 1st, the password to the website will change, and those who are not currently up to date and paid will be locked out, and you will no longer receive a newsletter until you renew your membership. So please make sure you go ahead and do that as soon as possible before the January 31st deadline. After that, there will be a $15 late fee added to your membership renewal. And this is not a time that you want to be without the support of BROA to help you navigate these trying times. So if we offer services that are valuable to you, please renew your membership. Our speaker tonight is going to be Tom White from White & Company, accompanied by his father, Ivan, who will be sharing some PowerPoints and handouts that will be viewed virtually. Please hold your questions. You can enter them into the chat box, and then I will read through those questions at the end of the presentation, and Tom or Ivan can address those at that time. Otherwise, if we have everybody trying to answer and ask questions in the middle of the presentation, it'll just be too chaotic in this virtual format to try to deal with that. So enter your questions into the chat box and we'll address them at the end of the presentation. So with that, I'm going to hand off the floor to Tom White. Feel free to introduce yourself, and the subject tonight is going to be taxes and everything related with that. So with that, welcome Tom and
Yes.
Ivan, and the floor is yours.
Okay, so if I share my screen correctly, we'll get started. Please do enter your questions in the chat. There's usually when we speak to you guys, there's a ton of questions, which makes it much more useful for everybody. So if you have questions, enter them in there. We've been asked specifically to, let's see here. See if I can share this. Okay, so we've been asked to speak about a couple different things. There's a slew of tax law changes that are involved with the stimulus bill. And we've also been asked to cover the tax implications of getting out of your property. So we've gone through several scenarios, different ways that you can get in and out of your properties. So if, just making sure I have everything on my screen there that I need. Okay, so we'll go ahead and get started. The first topic is correction of an error that was in the 2018 tax law. So it only applies to commercial property. So residential rentals, this does not apply to. But the change is humongous, because what it does is it extends bonus depreciation to commercial properties. Now, bonus depreciation currently is 100%. What that means is in the year you do one of these improvements, you can write it off 100%. And so what they've done is redefined commercial property improvements that you can expense in the year. So they're, as long as it doesn't enlarge the building's interior, basically as long as you don't add on to the building, it's deductible. So the three items listed there that you cannot do, you can't enlarge the building, you can't do an elevator, and structural framework doesn't count as either. But you can basically expense replacing the roof, the HVAC, fire protection systems, and any interior remodeling is all eligible for bonus depreciation in the year that you complete the project. Now, for several years, tenants that are running businesses in commercial properties have been allowed, since 2018, they've been allowed to do tenant improvements and use code section 179 to expense those improvements on their business schedule. But this is allowing the landlord to be able to take that deduction. And the weird thing about this is they made it retroactive to when the tax law was supposed to occur. There was basically a drafting error that caused this problem and made the property ineligible for depreciation. And that error is that on commercial property, those improvements historically have had a 39-year tax write-off. But now that has been changed to 15. And by making it 15, it became eligible for the bonus, which was the anticipated rule that they screwed up by not changing the 39 to the 15. So it took them 2 years to fix it, and they slipped it into the first COVID bill. I don't know how they got that done, but they just put it in there. Now, the interesting thing is you can fix this a couple different ways. If you did improvements in commercial property in 18 or 19, you can go back and amend those tax returns using 1040X and correct that life and correct it so you get 100% bonus depreciation instead of the 39-year life that you used. But you can also do what's called the change in accounting method. That's done by using Form 3115. And you do that with your 2020 tax return, and it allows a deduction in 2020 for the cumulative correction. So you actually get to pick which year you want to take the deduction in. So if you did commercial property improvements that you capitalized in 18 and 19, you can choose to fix those in those years, or you can choose to take the deduction all in 2020. So you get to choose which tax result would be the best for you. And so that is just the first thing that they changed that possibly affects some of you that have commercial properties. And it's a big change. Now that bonus depreciation is slowly going to go from 100%, then to 80%, then to 60%. But we really don't know what that schedule is going to be because we may have other changes that affect that. But right now for this year and next year, it's 100%. The second change that probably affects everybody that's listening is you now get to take a charitable donation deduction on, that's not an itemized deduction. So it's just a deduction from your adjusted gross income of $300 for single filers, $600 for married filing joint, both in 2020 and 2021. It started out that it was $300 for married filing joint, and they've changed it to $600. The purpose of this change is a strategy issue by whatever senators are involved in this. There are some senators that are upset that they raised the standard deduction to $24,000, and most people no longer itemize. So they're not getting any benefit for the charitable contributions that they make. And there's some thinking that we need to help these charities out. So they're trying to make a new deduction, and they're hoping that eventually they can just change the amount. It's just another way they're butchering the tax return, but they're attempting to get this done, and they got it done, but for now it's only $600. So you get that deduction, and then you also get your standard deduction. Okay, then the stimulus checks have caused a lot of questions because not everybody's getting them, not everybody's getting the full amount. And now people are getting debit cards when it should have been direct deposited. So there's a lot of questions. What those stimulus checks are actually an advance of a credit that is calculated on the 2020 tax return. So, and if you have no tax in 2020, you're going to get, and you received all of the payments, you don't have to pay them back. But it is a calculation of a tax credit. And so what that means is if you didn't get the checks, then you will get the benefit of those checks as long as your income is under a certain threshold. And then if you got partial checks, the reason was you hit the phase out because of your income level on the previously filed tax return. So either 19 or 18. And if your income in 2020 is lower, you'll get the balance of your stimulus checks with the tax return. There's a reconciliation form, and you'll get the recovery rebate credit. It'll show on page 2 of the 1040. Now, If your income is way up and you should not have been eligible for the credit, you get to keep the checks if you got them. So it's kind of a mess, and right now they're proposing, Biden has proposed doing an additional $1,400. I have no idea if that's going to be retroactively applied on the 2020 tax return. Most likely it should be the 2021, but that's being discussed now. The next thing is the stimulus bill, or the omnibus spending bill that was signed on December 27th. Did a lot of things that may or may not affect you. If you have employees because of your rental properties, you may have received a PPP loan. The PPP loans are basically grants, as long as you spend it on payroll. They're basically grants from the federal government based on a calculation on your 2019 payroll costs. And they were taxable because of a mistake in the first stimulus bill. So this bill made them non-taxable, and they clarified it, because the way it was taxable was they weren't going to allow a deduction for the expenses you paid from the PPP loan. So they've clarified all that. It's not taxable. And if you also applied for an EIDL grant and got the $10,000, that's also not going to be taxable. You may have to pay back the loan if you took the EIDL loan, but you won't have to pay back the grant, and it will not be taxable. Now, if you have a lot of properties and you have several employees and your income levels changed between 2019 and 20, there is a possibility that you could qualify for an additional PPP loan. It would be unusual for rental properties to have that situation. But if you do have that situation where you've had a revenue drop in 2020, there's a potential for additional money. The other thing, it's a pet peeve of mine that they did this, but they allowed the 100% business expense for meals for 2021 and 2022. They had finally gotten rid of this deduction. It's one of the more abused deductions. And so they had finally gotten rid of it and nobody was complaining, but apparently the only way they were going to pass the stimulus bill, Trump insisted that this deduction be included. So for whatever reason, that was very important. And now we have the ability to deduct meals again for 2021 and 2022. So keep your receipts, you get to deduct the business related meals. A few other changes. There's actually like 50 tax provisions, but we tried to just include the tax provisions that would affect most of the people that are listening. They extended permanently the itemized deduction medical expense that exceeds 7.5% of your adjusted gross income. So when you have medical expenses and you itemize your deductions, they were getting a haircut of 10%. So you had to subtract 10% of your adjusted gross income from your medical costs in that calculation of your itemized deductions. They've changed that back to 7.5%, which is the old rule. So you could see a trend here that some senators or congressmen got their favorite previous tax deductions back through some of these provisions. They also extended for 5 years the exclusion from income for the discharge of indebtedness on the principal residence. Basically, if the bank foreclosed and there's a forgiveness of debt, it's not taxable income. That's been extended year by year or multiple years since 2008 when everything went haywire in the housing market, but they've now extended it for 5 more years. Also, there's an exclusion on the employer's payments of student loans. That's a unique one, but if you have an employer that's willing to, they can pay part of your student loan and it's not considered income to you. I guess that's somehow the way the government's trying to get people to pay their student loans. For 2 years, they've extended the energy tax credit for residential solar energy property. So insulation, windows, roofs, skylights, anything that you do, you can generate up to a $500 credit. So you just have to, if you have something like that, that credit is now renewed for an additional 2 years. for 1 year, they've changed it now, and this mortgage insurance premiums are if you've borrowed more than 80%, the bank makes you pay mortgage insurance premiums on your a residential loan. And it's basically just an extra cost that everybody should attempt to get rid of. But they've been treated as mortgage interest for itemized deductions on a year-by-year basis as they extend this rule. And so they've extended this just for 1 year. Now, if you're paying mortgage insurance premiums on a rental property, it's deductible no matter what, because it's on the Schedule E, not the Schedule A. This is just for the itemized deduction rule. Okay. The other thing that happened, and probably if you're over 70 and a half, you were aware of this, but they eliminated the required minimum distribution for 2020. You don't have to make it up. You just got to literally skip a year of your required minimum distribution. So, but they've also changed the law in the middle of all this because of a Retirement Act. And now if in 2021, if the required minimum distributions begin if you're 72. Now, if you had to take RMDs because you turned 70 and a half under the old rule, you still have to take them. But now new people that reach age 72 have to begin their RMDs at that point. They also, effective next year, so 2022, they're changing the life expectancy table. So that's going to reduce the amount of your required minimum distribution by a decent amount once they update that table. It was supposed to go into effect for 2021, but because of COVID, the IRS didn't get their job done. Don't mean to be critical, but they didn't do their work, and they finalized the regulations so late that they've extended it 1 more year. An important note is you could still do qualified charitable distributions out of the IRA directly to charity, and they're not counted as income. They show up on your tax return funny. On the IRA line, you get this little QCD code next to it. So you're still eligible to do that on the required and use the charitable distribution to reach your required minimum distribution. Okay, so those are the major tax provisions that will impact some of you or all of you. And there's a lot more, and there's a lot more that are going to be proposed. But those are the ones that we know for certain, and a lot of those will affect landlords. So the next section of this is when you sell your rental property, what options do you have? So we've come up with some that they wanted us to cover, but we're basically going to go through the things you should consider on different ways of selling property. So the obvious and most common way you get out of a rental property is you sell it for cash. And if you sell it for cash, you're going to have a gain if you've held the property a long time because you've been depreciating that property, and the property hopefully has appreciated in value. So that gain, one of the considerations that we warn people about all the time is that a large gain can affect your Medicare premium 2 years after the sale date. So there is a rule that adjusts your Medicare premiums based on your income level. So if you have income over a certain threshold, you will trigger a higher premium that lasts for a full year until your income drops back down under the threshold. So I'm not going to go through the detailed calculations of what those thresholds are, but just realize in the year you trigger that gain, you will in future years have a higher Medicare premium if you go over those thresholds. Now, when you sell property, you have multiple components of the gain. Some of the gain is going to be unrecaptured Section 1250 gains, which is a horrible definition, but basically it's the amount of depreciation you've taken on the property. and that gets a special maximum tax rate of 25%. The rest of the gain is just normal capital gain, and that has different maximum tax rates, and that's covered in item C. The capital gains tax is currently 15% if you're above the 12% bracket. And well, I should back up. The tax brackets are marginal. So for the first $80,000 roughly of taxable income, you actually have a capital gain tax rate of 0. And then after that, it's 15% until you reach taxable income of 496,000, when it increases to 20%. And so that's pure capital gain. The Section 1250 gain never gets that 0% rate. So it's 12% and then goes to 22 and maxes out at 25%. So an example may help here. If you bought a property for $90,000, and I know nobody can buy a property for $90,000 now, but the numbers make it easier to give the example. And you take depreciation of $10,000 while you're renting it. Your basis is then $80,000 because you bought it for 90, you've depreciated 10, so your cost basis is now $80,000. If you sell it for $100,000, you have a $20,000 gain. But 10,000 of that is this unrecaptured Section 1250 gain, and 10,000 of it is true capital gain. So then you got to look at what tax bracket you're in to see what rates apply to that gain. So that's the complication that comes with just selling for cash. The biggest surprise is that Medicare premium, but also some people get surprised because they think all of their gain is subject to that lower capital gain rate of 15%, and it's not. If you go over certain thresholds, it could be 20, and to the extent of depreciation, it could be 25%. Okay, the second option is you sell on a real estate contract. So basically you use an installment sale and you sell it for a down payment, and then you collect the balance over whatever terms that you want to agree to. The terms can be anything that you and the buyer agree on. For example, we've got here on item A that you can have a 9-year term, but you want to amortize the loan over 30 years, which basically creates a balloon payment due at the end of 9 years. We like to have balloon payments either at 5 years, 10 years, somewhere in that time frame, because you force a renegotiation of the interest rate, or you can collect your money, depending on what you want to do. But agreeing to a 30-year installment contract now at an extremely low rate may not be the best option, because you may be stuck in that extremely low return on that installment contract. Now, how is the installment sale taxed? Basically, if we take that same example, that you bought the property for 90,000, you depreciated it at 10,000, and you sell it for 100, your gain is 20,000, which works out to be 20% of the sale price. So in the year of sale, you're taxed on the down payment and principal you collect times that gain percentage. So if you collected a $10,000 down payment and principal payments, you take that times 20%, which is your gain component, and you'd have $2,000 of capital gain based on the principal payments you receive. You also have income based on the interest, and that is not capital gain. The interest is taxed as ordinary income. So as you collect the principal, you pay the tax on the percentage of the principal payments that represent that original gain. So you can stretch that tax out so that you, one, avoid the Medicare premium increases, and two, you can avoid having a very high tax rate on some of the gain in the first year if you collected cash. So the installment sale is very beneficial if you're trying to stretch the income out. A couple other things to think about is that as you collect the principal, you report the gain. So unless you have a no prepayment clause in the contract, the person can pay you off whenever they want, or whenever they can refinance the property. So if you're truly trying to stretch the gain out, you would want to have in the agreement that they can't prepay it, because you don't want to get that lump sum gain that causes you to go into a higher tax bracket or create those Medicare premiums. The other risk that we see in a lot of cases is you don't get a big enough down payment to avoid the risk of repossessing it quickly. So you should always consider taking a big enough down payment that the buyer has enough skin in the game, that they don't treat the property badly and just give up on it if something goes wrong right off the bat. So that's the installment sale option. The third option that we're going to discuss is doing a 1031 tax-free exchange. Basically, you're selling a property, but you have to buy a property. So if you're trying to exit having to manage rentals, this may not work as well, because you've got to buy some other property. Now, under the current rules, if you sell real estate, you can buy any real estate. So you could sell single family residence and buy just open land. So you don't have to necessarily buy a single family, sell a single family residence and buy a single family residence. Any real estate can be exchanged. So as long as it's considered real property, you're okay. You do have to involve a facilitator, and there's specific timing rules that are involved in the tax-free exchange. We generally recommend that to do a 1031 exchange, you have to have what you want to buy available, and you have to have the buyer for what you want to sell available at the same time. It's very difficult to meet the timing deadlines otherwise, because from the date of the sale of your property, you have 45 days to identify up to 3 properties that you're going to exchange into. So if you go beyond that 45 days, you can't identify a new property. And then you have 180 days or 6 months to close the transaction. So this does not work unless you have what you're going to buy somewhat lined up. And item C there, you have to exchange your gross sale proceeds. So if you sold the property for 100,000 in our example, you have to buy a property of at least 100,000. If you don't, you recognize gain to the extent of the shortfall. So in our example, we had a $20,000 gain on a $100,000 sale. So if you found a property that was 85,000, you don't get to prorate that. You have to recognize the $15,000 of gain. So you have to exchange up, meaning you have to invest at least the gross proceeds, or you're going to trigger some tax. So though the 1031 is a great option, but it's got you got to get all your ducks in a row to take advantage of it. Now, the fourth option that we've identified is you can do a 1031 tax-free exchange into what's called a Delaware statutory trust. It's commonly referred to as a DST. If you do a Google search, you'll find a bunch of DSTs that you can purchase. Basically, a DST is a single purpose trust that owns property, and then they sell shares or percentages of that trust to anybody that wants to purchase it. And it does qualify as real property for the 1031 exchange rules. So the trust basically is a third party that goes out and buys large properties that they manage, and then they sell shares in that. And so the trustee administrates the property and manages the property. So typically they're buying very large tracts of property. The most recent one that I looked into was actually a farmland DST. And so they were buying very, very large farms. They were managing them. They were actually hiring farmers to farm them. And so you got your return there was the value of the crops that were produced. So the return was actually fairly decent. It was a very interesting seminar that I listened to. But the things you have to remember on this one is there are fees involved with the 1031, and because of the DST, that could be a little more complicated, as opposed to exchanging into a rental property that you have to manage. This one's managed for you. So if you wanted to exit out, but still have a real estate exposure, this isn't a bad option. It is considered a private security, so you have to follow the accredited investor rules. So you have to disclose your net worth is $1 million. There's several rules. They can't just sell this to anybody. But the nice thing is that the sale and purchase of the shares is private. No, it's not published anywhere. So nobody really knows that you own that DST share, because you're not actually owning the underlying property. You're owning a percentage of the trust that owns the property. The only downside that we see is when you want to get out of this, it is a private security. So you got to find a buyer, and that could take an extended amount of time because these are not extremely liquid assets, because it's not an entire property. You're just owning a share of a trust that you don't control. So it would be basically determined by how well the trust is managed, how well do they market the shares, what has the return been. So you could have some issues when you want to sell. Because of the way the trust is, the trust share would receive a step up in basis at death. And I'm going to get into that a little bit more just a little bit later. So, but just realize that this would also qualify for the step up in basis. This is actually the one we were asked to comment on in the presentation. And that is if you sell your property to what's called a deferred sales trust. And while I've had people look into the Delaware statutory trust, I have had people look into this. I've never actually seen this one completed. But what it is you basically sell your real estate to this trust on an installment contract. And supposedly, if you could sell to the buyer on an installment contract, you wouldn't need this. But if you had a cash buyer, you could use one of these trusts to create an installment sale, even though the sale is not an installment sale. So basically, you sell the property to the trust on an installment sale, and then the trust turns around and sells the property to the third party. Now, the trust just purchased the property for the same price that they're selling it, so the trust does not have any tax. You're the one that has the tax, and it's deferred in that installment sale. The trust manages the proceeds and then distributes basically the installment payment to you on however you set up the installment contract. And you set up that installment contract ahead of time based on what terms you want to receive. Some items that you have to consider here is, as you can probably tell, this is not something that is easy to set up because you have to meet requirements for independence on the trustee, because you can't sell to yourself. So you're really hiring a third-party trustee that's going to manage your money from the proceeds and pay you an installment payment. And so there's quite a bit of attorney fees and third-party trustee fees every year that the trust is in existence. And then you're going to have all the normal selling expenses like drafting the installment sale, doing the transaction, etc. And you can amend the agreement with the trust as long as it's basically done on a third-party basis. And so you can control what payments you receive as long as you're not just manipulating the payment to get some certain tax advantage or tax structure that's beneficial to you. It's got to be a normal transaction with the trust. The problem that we see right now is the trust is going to receive this money, and if they put it in a bank account, it's going to earn what you're earning on your savings account, which is 0.001 or whatever bank you're at. It's an incredibly low rate. So the rate that you're going to receive on the installment sale cannot exceed that because they will run out of money. So you're limited unless you buy bonds or stocks or something within the trust that have volatility with them. You cannot get a very good return on your money during this. So it's basically a deferral strategy that you would use so that you basically can control the principal payments you receive over the term of the installment note. So there's probably some limited use for this when you have a cash buyer, but you got to be willing to incur the costs of doing all that. So those are the strategies we come up with. If you want to put questions in the chat, I can go into much more detail, but I didn't want to get too detailed. I wasn't sure how well this would work over Zoom as opposed to in person. So hopefully those options make sense. I will tell you that with the current capital gain structure, if you're going to sell, we typically go toward the cash sale unless you're going to have a variable tax bracket over the a few more years so that you could take advantage of the installment sales rules. There's also ways you can sell the installment contract that you have to trigger tax in a year that's more beneficial to you. So there's strategies that you can do with the installment sale. The installment sale, the one thing people don't realize is once you've done an installment sale, if you die and somebody inherits that, they have to pay tax on the payments just like you would have. The installment sale does not receive a step up in basis. So that has been a shock to some beneficiaries when we've been involved in that. So all of these options have pluses and minuses, and you just have to look at your own circumstances to decide the best way to get out. Okay, so the last option that is not really a sale, but it's the best option is if you hold property until death of one of the spouses. And the reason for that is at death, you get a step up in basis in the property. And what does that mean? Well, your tax cost, in our example, we used $100,000 or a $90,000 purchase, and you depreciate the property $10,000, so your tax cost is $80,000. Well, if it's a husband and wife that own that property in the state of Washington, because it's community property, if one of the spouses dies right before the sale, that property would get a step up in basis to that $100,000, and it could be sold for no gain. So the step up in basis is an incredibly valuable tax law because nobody intentionally dies to get it, but it's just a tax change that occurs upon death. So unfortunately, we have probably one or two tax returns a year where mom or dad becomes unhealthy and they have rental properties, and without consulting anybody on for tax purposes, because they've gotten cancer or they have a terminal interest, they sell the property because they don't want to manage it anymore. And so they have the gain. And so the issue there is, if somebody's terminal, you would never want to do that. You'd want to hold it until they pass, and then you'd get the step up in basis and could sell it for no tax cost. So that step up in basis is incredibly valuable. And that's why on the 1031 exchange, you avoid the gain because the gain just goes into the next property. So if you don't want to manage rental properties, but you do a tax-free exchange into, say, the Delaware Statutory Trust or into open ground that's easier to manage, something like that, you can hold that easier to manage property until death, and then everything receives a step up in basis, and your heirs or your spouse can liquidate that for no tax cost. Now, item 3 there is fairly important, is that Biden is proposing to eliminate the step up in basis rule. And that would be incredibly devastating to people that hold property for a long period of time. And the reason is you pay tax on appreciation. So basically you're paying tax on the inflation. And if they do eliminate the rule, your heirs will pay that tax. So that's something to pay attention to. There's no Biden's tax proposals are incredibly basic. There's very little detail to them. So I'm not sure what to take from all this, but it is in the list of one of the things he wants to do. And given that inflation has happened, especially over the last year, with the drop in interest rates, the shortage of inventory, a lot of property values have gone up. In the state of Washington, an individual person can be worth $2.193 million at their death, and there's no estate tax. If you go over that, the estate tax starts at 10%. And so a husband and wife can be worth twice that. As long as you have the will structure in place, you could take advantage of both individuals' 2.193 million. And so for federal purposes, you get that step up in basis. But if you're holding a lot of property, you're probably going to incur Washington estate tax to get that. And the federal exemption, what can you be worth on a federal basis? Well, right now in 2021, you could be worth 11.7 million each and not have any federal estate tax. So we haven't really talked about the federal estate tax for several years because it's gotten so large that not many people hit it. But the state amount is much lower, and people sometimes are surprised at how low that is, given that it doesn't take too many properties to get to that figure. Now, Biden has also indicated that he's going to get rid of the step up in basis, but he also wants to reduce that $11.7 million exemption down to $3.5 million. So much closer to the state exemption amount. But where the state's estate tax starts at 10%, the federal tax starts higher, and the maximum tax at the federal level, he wants to change to 45%. So if you can see what he's doing, it's very devastating to people that build wealth, because he wants to eliminate the step up in basis and increase the estate tax. So those two things in combination would be a drastic change. It would substantially change many people's estate plans. So we'll see how those things can move forward. Normally, the estate tax provisions can pass fairly easily when the Democrats are in control, because they could just say that the rich need to pay more tax. So they don't realize that that catches a lot of property owners that you would not consider to be wealthy. Number 8 is a little scary. Washington Senate Bill 5096. So I know as landlords, you're not very happy with our state government right now. And this one is incredible, but they have, Inslee proposed, and they've introduced a bill that would impose a 9% excise tax, and that the word excise is very important. I'll explain that, on capital gains for state residents. Now, in the bill, single family residential homes, farmland, and timber are excluded. And it appears that it's excluded just for landlords and for primary residences. But realize, just like all these other things I was talking about, like the charitable contributions being on the outside of the itemized deduction, just becoming a deduction, once a law is in place, it's incredibly easy just to change a component of that law. So they could easily strip out single family residential homes that are not primary residences, because that would match up with the federal rule better. So, and of course, this is just a bill, so it hasn't been reconciled. There's nothing in there. So this could change. And currently it would apply to gains in excess of $50,000 for a married couple. So you could see on a duplex or a triplex or a multifamily property, you would get there very quickly. And this is a flat tax of 9%. Now, I read an article, I think it's public tax policy. There's a group, and I got their information through the Farm Bureau. The purpose of this Senate bill is to intentionally get the Supreme Court to throw it out, because capital gains have been decided by the US Supreme Court and by many states that capital gains are income, and our Constitution does not allow a tax on income, hence the word excise. So the point of this is there is some legal argument that can be made that if they throw this out, the Democrats feel that they have a better chance of implementing a true income tax without having to change the Constitution. Now, the article I read doesn't explain how they think they can accomplish that, but the ultimate goal that the Democrats have right now is to implement an income tax in Washington state. And this is just the first step in trying to get that done without changing the Constitution. So that's definitely scary because they have control of everything and they are out to get this, and they're blaming the budget deficit because of the shutdowns in order to do this. So those are the income tax and estate tax changes that Biden is proposing, or the state is proposing, that we think you should be aware of. And with that, that is the end of what we had prepared. It's much shorter than what we normally do, but none of you could interrupt me with questions. So if anybody has questions, I don't know if there were any that were done.
I don't see any yet, but does anyone have any questions?
Well, we definitely appreciate doing this. It's definitely a different different feel doing it over Zoom. So if anybody has any questions or they want copies of the slides that I went through, you could feel free to email us or get a hold of Jody and she can email me and we can share that easily. So if you want to email it, if you want to write this down now, my email address is tom@whitecocpa.com. So it's WHITECOCPA.com.
Okay, we have one other question. It says, is Biden going to take away CGI?
CGI, I'm not sure what that's an abbreviation for. If you want to clarify, I assume that's capital gain income. And he's not proposing to take away capital gains. He's proposing to eliminate the preference rate. And currently that's at $1 million. I may have skipped that. I thought I had that in the presentation, but I may have skipped that as I was talking. So the issue is what income level are they going to get rid of the preference and treat capital gains as ordinary income? There's no published information, but Biden indicated that it was going to be around $1 million in some speech. But to me, that's incredibly unlikely that they would have it that high. They kind of define high income around that $400,000 mark. So my guess is that if they do propose something, the capital gains will stay the same at the bottom end of the scale. But once you get to a higher level of income, and that could be 200,000, it could be 400,000, it could be $1 million, you no longer get the preference and it becomes ordinary income. Now, the most likely change that they're going to make is go back to the old tax rates. So currently we have 12, 22, 24. It's going to go back to 15, 25, 28. And the top rate, instead of being 37, will go back to that 39.6. So there's a potential that capital gains will be taxed at that 39.6% tax rate. So that's it's definitely clear that they want to impact people above a certain income level. It's just, where is that going to be? But he definitely has proposed eliminating the preference rate for capital gains.
Okay, thank you. Hilda, if you want to email me, I can give you Tom's email address and we can share that information with you of his presentation. Paul says he will send out a link of a recording of this presentation so people can watch it again if necessary. So are there any other questions at this time from the audience?
Yes, I had a question. This is Evan. Um, so in terms of getting a property secured for a 1031 exchange, are there any like tips or tricks to, I guess, kind of maybe not put all of your eggs in one basket, or make sure that the property goes through?
I guess maybe just repeat that again. I'm not quite sure I understand the question.
Are there any like tips or recommendations when using a 1031 exchange to, I guess, ensure that the transaction goes through?
When you mean go through, do you mean qualify for the exchange rules? Is that what you mean?
Qualify for the exchange, but say if a sale doesn't materialize, you're just wasting time.
Right. Well, the initial fees for the 1031 are not huge. What you have to do is use a facilitator. And if you think you might possibly have a property you can buy, you set it up as a 1031. And you might be out $600, $1,000 for the exchange facilitator setup fee, but you only have the 45 days. So there's really to identify in 180 days to close from the date of the sale. So if a sale falls through, if the sale falls through, you're fine, because you don't start the exchange until the sale date. It's if the purchase falls apart that you have a problem. So it's the purchase that always causes the issue, because if for whatever reason your purchase falls through, you're trapped in those days and there's nothing you could do about it. So if you're beyond the 45 days and a purchase falls through and you've only identified that property, then you can't exchange. You're done at that point. So that, I think that answers your question. But if the sale falls through, you're probably not out anything, because the exchange facilitator normally doesn't charge anything until they have to set up for the sale. Does that answer your question?
Yeah, I think so. And is it true that after you've selected a property, say like the timer stops? So if 5 days go by, I find something I like, I say I want it, does it stop the timer? And then if that purchase falls through, then I've got 40 days to find something, or does the clock still tick while you're going through?
You typically identify them all at the same time, but you have 45 days to identify. And I'm almost certain that you can identify properties at different dates as long as it's within that 45 days.
Okay.
I did want to clarify that on the $300, $600 charitable contribution, that only applies to cash contributions, not non-cash contributions. My partner is texting me on that.
We have another question, actually a clarification of a previous one from Sharon Hoffman. She asks, will Biden eliminate the QBI deduction, is what she meant to say on the Schedule E?
No. The QBI deduction appears to be here to stay. They do want to eliminate, there's income levels where that phases out for specified service businesses completely. And then other businesses, if they don't have wages or basis in property, UBIA. But so they may change those thresholds on when it phases out, because they don't want higher income people to benefit. And if you could see what's happening, they want to collect all the tax from taxpayers, say above, I don't know what it's going to be above. The problem is it could be above 400,000 when they start the negotiation, but they truly may want it down at 100,000. We don't know yet, because there's virtually no detail to any of the cutoffs that they want to propose. So that will be part of the negotiation in the tax bill. But from what I've read, the QBI deduction is here to stay. And if you're an accountant, that's unfortunate, because it just complicates the calculation. But it is a deduction. They should have just done it by reducing rates, but it appears they're gonna leave the QBI in the tax code.
Are there any other questions?
I am being asked to clarify that the residential energy credit that's coming back is only for the personal residence, and it's subject to a $500 lifetime limit. So I must not have clarified that when I said it.
Okay. All right, I don't see any other questions, so thank you very much, Tom. Like another person commented, it's a lot to absorb. And so we certainly appreciate you going over that with us and sharing any updates. Death and taxes, they never get better. So,
So, and if you have any questions, feel free to email us. We'll reply as best we can. And if you can't get to Jody to get the presentation, I'll get it to you some way. So
perfect. Thank you
for
so
having
much.
us.
All right, you guys have a good evening, and thank you for joining us.
Yep.
That's all, folks. Have a good evening. Thank you.